Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Joining me now are your hosts, Greg Klipstein and Samantha Lawrence. Greg and Samantha, let's get things started. Greg, why don't you start us off? What is today's topic?
Today we're going to talk about the qualified business income deduction, frequently lost opportunities.
Elaborate a little further. Well, what does that really mean?
Well, so qualified business income is what a business owner earns from their business. It is exactly what it sounds like. For context, back in the start of the Trump administration, there was a huge cut in corporate tax rates for C corporations, publicly traded companies. There was an outcry of how that was unfair to small business owners who employed north of 75% of all the employees in our country and produced a vast amount of the revenue that the IRS likes. And as a result of that, the Trump administration, as it was developing policy, created a deduction for small business owners that would put them pretty much on par with what was happening for taxation for large publicly traded corporations. That deduction is complex, though, in terms of how it's implemented. There are two factors that are commonly looked at: the earnings of the company, the wages of the company. And because of the interplay of those two numbers, that deduction, if people aren't paying attention, can be missed. Or if you've structured your company in the wrong way, say it's a sole proprietorship, you may also miss the opportunity to avail yourself of that deduction, and you may be paying more in taxes than you otherwise ought to.
Is there a simple solution?
The answer to that is no. That's something that requires a little bit of planning and foresight from all of the advisory team. Thank you for asking that, RJ. You can't simply just go back and wave a magic wand and make things different for the prior year. There's a process for that, and happy to talk through what that process might look like. On a go forward for clients, they should be mindful and make sure that they're keeping the appropriate ratios between top line earnings and wages that are being paid out to the owners in line so that they're able to avail themselves of that maximum deduction.
Yeah, thanks, Greg, for sharing the overview there. Just taking even a step back, so in terms of what we do, how much are with the clients we work with at Centura Wealth Advisory, primarily being the ultra high net worth, how often do you see QBI in this opportunity popping up, or let's say missed opportunity?
Well, so that really is a function of the kind of the company that our client owns. If they own a C corporation, it will never come into play. It's usually for a pass-through entity, so partnership, LLC. On a percentage basis, for our pass-through clients, I'd say it's probably about 1 out of 4 so far this year where we've missed that opportunity or seen that opportunity being missed.
And when you say seeing the opportunity being missed, you're recognizing this, let's say, on the prior tax return for the client, and it's something that what professional in their group should have been tracking this, or maybe who. A lot of oversight happens with our clients. There's so many different things going on. Business owners, ultra high net worth, they have different entities and everything. So do you think this is a commonly missed mistake because it's just a small little item, but it could have a bigger tax savings if it was paid more attention to?
Yeah, experientially, I think it is being missed more frequently than we think and more frequently than our clients might think. The people who are responsible for it really are the entire advisory team, but they need to communicate in advance of the end of the year for the given business owner. And so on the one hand, for their existing tax preparers, they may not be taking the foresight to have that conversation at the end of the year with their client and are just reacting to something that's already happened when they get the final numbers from the business in January or February and need to start preparing taxes. For their other existing advisors, they may not really understand the mechanics of how this operates and the lost opportunity for their clients.
In terms of looking at that for the client, so let's say you get the financials come January or February, but and they're looking at it, let's say, but wages have already been put through for, let's put it in the 23-24 tax year. We're looking at clients' extended tax returns right now, and we're like, hey, you've already submitted wages, but we see now that there's this missed opportunity. Is there any way to go back or fix the problem?
There is actually. So for a few of our clients, we're going through this process live, and as we speak right now, There's a form, of course, that you report the employer side withholdings for whoever the employees are. That's a Form 941. There's a Form 941X so that you can amend whatever reporting you undertook for the most few recent quarters. And W-2s and W-3s can also always be amended. There's a question of how far back in time you would want to go. I don't know that I would want to go back 2 years. I think I would want to do it during a current tax year, or rather during that current reporting cycle for it.
Right.
But that's really the mechanics behind that. And then you have to make sure that you're paying the appropriate amounts of employer withholding for that new employer withholding, basically form reporting that you're filing with the IRS and with the local tax jurisdictions.
That makes sense. Is there a simple formula in terms of figuring out the optimal QBI, or what really goes into figuring out how to really optimize it for the client?
You have to run two calculations at the same time, and that's just a math problem. But to give you a sense of what those calculations look like, the deduction is limited to a combination of the lesser of 20% of the net profit that's being paid out to the owners, or 50% of the company's wages. So let's just use an example where you have one employee out of an S corporation, for instance. If they have top line income of $2 million, that deduction then would be limited to $400,000. Except if they didn't pay themselves any wages, now because it's the lesser of 50% of zero, that deduction is, well, half of nothing is nothing. You get no deduction for that. And so you really need to look at both of those factors at the same time, increase compensation, decrease compensation, so that you can impact earnings. And if you have many, many employees for a larger company, then you may just be stuck with where you are, all things being equal, because you don't really have the opportunity to materially move wages in connection with earnings from the company. It's a very fact-specific calculation.
Yeah, so that makes sense, Greg. It seems like it might be easier to actually perform this deduction for, let's say, sole business owners that really only have no employees, or they're the sole employee, or maybe there's only a couple, and it gets a little bit more complex for the larger businesses with a larger group of employees.
Absolutely. And certainly with larger companies with larger employees, you lose some of that flexibility to plan toward the end of the year.
Right.
For sure.
How does this QBI optimization play in with maybe any other strategies at hand on the tax return, or planning strategies in general?
Well, so let's go to the business owner who's simply been taking all of their earnings out of the company, and they've been doing that historically for 1, 2, 3, 4 years, and they don't take it out in terms of wages. There's other strategies they won't be able to avail themselves of because they're based on how much their wages were. So, for instance, a defined benefit plan, or really any retirement plan of any kind, could be limited if you're not taking earnings out of the company. Consequently, then, you're losing an opportunity for current tax mitigation, and certainly with a defined benefit plan and its increased ability to defer future amounts over time and create a current deduction as an outcome of that current funding, well, I mean, that opportunity just goes away. And that's the kind of opportunity that you really can't recapture. If you missed it, say, in 2020, 21, 22, it's gone. You're never really going to get that back. And in 2023, there's really a limited amount of time, and it's not available to somebody who's just picking up their tax return and looking at it right now.
Right. And even for clients that, let's say, they're not evaluating a retirement plan or a defined benefit plan in the current year, I know that when they do evaluate it, they look maybe 3 years back at wages and take the average there, and that goes into the testing. So even if they're increasing wages, it can still be a future benefit if they decide to implement a plan, a retirement plan, specifically defined benefit in future years.
Yeah, absolutely for that. And even if you're not implementing that retirement plan, the benefit of the deduction in and of itself, it's essentially free money that was lost by not undertaking that.
Yeah. So with that opportunity that's lost, what do you think? This is one small line item on the 1040, that qualified business income deduction. Do you think there's other opportunities being missed if this is just one small item?
Well, so for something that it's just a math problem of sorts and just requires talking to the client, having an understanding of what they're doing throughout the course of the year to fully lever this, you wouldn't know how many other opportunities are being missed. And that's probably because they're never even being discussed or surfaced. I see something like that, and my first reaction is the tax preparer isn't talking with their client throughout the year. They're reacting in January or February. Opportunities are gone, or can be lost. And maybe they're just an order taker, or they're just filling out forms from a compliance perspective, as opposed to being thoughtful around what they could do on a go forward basis. And more to the point, they may not be looking at their own work product, seeing that there's an error of sorts or a missed opportunity, and trying to figure out how to correct that. I mean, there's so many different things that could further be highlighted with that for their clients. I mean, can you think about what might happen with a client if they're trying to sell a company and their current advisory team just isn't really doing something for them?
Definitely. It seems like, especially in my experience, that a lot of the tax accountants or CPAs are working in more of a reactive base and more of just a compliance point of view. So they're really not digging in on the consulting aspect. And that seems like that's, in my experience, the biggest opportunity missed among most clients is they have reactive professionals that really just look at the top line and are trying to check the box and get it complete and do as much as they can, but everyone's at capacity. So they're hitting the compliance, but not really have capacity to focus on or spend time with the clients on the consulting work. And I think that ties into kind of just with financial planners and wealth advisors like Centaur Wealth Advisory, and how we really can play that quarterback role and find these small, teeny opportunities that do make an impact. That it's not to say that they have other bad professionals on the team, right? It's just everyone is so busy that there's no one, it's more of a gap in service offering. No one's really digging into or filling that role for them.
Well, for sure. And, giving everybody the benefit of the doubt of the world out there, for a lot of CPAs, that offering is completely appropriate for their client base. They don't really have that much complexity. I think with our preferred clients, it's more often the case that they're outgrowing or they've already outgrown some of their existing advisors.
Most definitely. It seems like they acquire those advisors when they're early on in their career and things launch for them, but they don't really have the time to go interview new professionals, find new professionals that have new skill sets. So it's comfortability and ease of access, right?
Well, right. And, that's really one of the benefits of what we do for all of our clients, right? We're looking not only at what they've done in the past, we're trying to be mindful of what's a possibility for the future. And then we make sure that their existing advisory team can actually implement those kinds of strategies. Clients don't have the time to do that. I mean, if you're running a business, you literally don't have the time to be in the center of all of those interviews and then monitoring those professionals. Why would you do that?
Yeah. So when you find out that there's a missed QBI opportunity here and you, let's say, present it to the client or even go back to the prior CPA or the current CPA and present these findings, what is their typical reaction?
So a lot of the time they're kind of sheepish about it. They'll look back and say, oh, wow, I missed the ball on that. Or, we had this happen or this other circumstance. I've had some preparers say, yeah, we've talked about this before in the past and we just didn't get around to fixing it, which, I mean, that blows my mind, but there you are. I mean, I've never had a preparer say they don't know about the deduction. I usually just get someone who's being sheepish and saying, I don't know how to fix that, or we just didn't plan for it.
Yeah. When you take a step back and as you continue to work with these clients, I know in my experience, there's changes that occur in the future. So how easy, and maybe say, what is the likelihood that when you have a new client come on board within the next 6 months, how often are you replacing, say, their CPA or other professionals on the team?
Experientially, it's depending on where the professionals are coming from. And I guess there is sort of a bright line. There are certainly some professionals who are very good at what they do, and they're often introducing their new clients to us. And we are, of course, introducing our clients back to them. For the rest of the world of professionals that are out there, I think we're replacing them probably about 100% of the time. And that's not to disparage them. They just lack the skill set to fully address the complexities of the clients that, we do best for.
Right. Yeah. And I would say just from an internal process at Centura, like vetting the professionals we work with and finding those top-notch professionals that can really add value and are also daily vetting all these new strategies and figuring out ways to really have their clients optimize their situation. It's a lot of back end work for us even, but we're always vetting new people to try to figure out who's the best professional to refer our clients out to.
Yeah, for sure. And that's also, I think, a function of us being a little bit more self-aware of, how we're best serving our clients and never putting our own interests ahead of theirs. And we're always trying to figure out who the best person is to undertake part of their advisory world, and then take the client out of the center of having to coordinate that.
Okay. That all makes sense. And I think that QBI deduction could really serve a lot of business owners well if they look back and can try to optimize that on the go forward.
Yeah, for sure. And, certainly a second set of eyes never hurts for anybody.
Do you have anything else, Greg, to add to QBI or anything we should learn about today?
I don't want to try to overfluff QBI and make it more complex than it really is. It's more of a tell of whether or not your existing advisory team is, serving you the way they ought to.
Totally makes sense, I think. Any small opportunities could still be big opportunities in the grander scheme, so it's definitely valuable overall.
Absolutely. I mean, if there's one other takeaway, I would just say, the lowest cost provider, may cost less in terms of fees, but, what are they really costing you in terms of missed opportunities? And that's probably the better way to look at it.
Okay, how about some contact information, Greg and Samantha?
Yeah. So our website is centurawealth.com, and on there you're actually able to find all of our contact information, specifically me and Greg's. Both emails and phone numbers should be accessible there. You can also find us on LinkedIn, just Centura Wealth. And please reach out if you have any specific questions about QBI, about anything in general. We're happy to connect and schedule a time to meet.
Excellent. Thank you, Greg and Samantha. And most importantly, thank you for listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you've not subscribed to the podcast, please click the subscribe button below. This way, when the team comes out with a new podcast, it will show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at Centura Wealth Advisory, I'm RJ Malik, reminding you to live your best day every day, and we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.